the damage being done to the global economy right now. Welcome back to N.D.P News, where we explore current international affairs. Over the past 3 weeks, there has been a growing chorus of doomsday predictions in the financial world. Many experts have been warning that a global financial crisis, like ones we have experienced in the past, may be on the horizon. This fear was further exacerbated by the collapse of 2 major American banks, as well as the industry bailout of a third bank, which caused a run on smaller regional banks. To make matters worse, Credit Suisse, a major European bank, has struggled for over a decade and recently has taken even more of a downturn. This unfortunate combination of events led to a widespread panic among stock investors, resulting in the loss of around $500 billion from the value of banks. While some may argue that this was just an unfortunate coincidence, there is no denying that the rapid pace of interest rate hikes has severely rattled the foundations of global finance. Despite the warnings, the European Central Bank proceeded with a supersized rate hike last month, possibly to avoid appearing too concerned about the situation. However, this move has raised many questions about the wisdom of future hikes and the speed at which they should be implemented. There is an old saying that goes, "The Fed will continue raising rates until something breaks." The recent collapses of Silicon Valley Bank and Signature Bank may not be evidence that something is broken yet, but they are a timely reminder that sudden changes in monetary conditions can have unintended consequences that can lead to chaos, contagion, and calamity. The focus so far has been on interest rate hikes, but another more insidious danger is lurking. Central banks are deliberately attempting to drain the global financial system of the cash they injected during the pandemic. This move could have severe consequences for the economy, particularly for those who have taken on debt during the pandemic. While the situation is not yet dire, it is crucial that we take steps to address these issues before they spiral out of control. Please take a moment to subscribe and like the video as we continue to dive deeper into the situation. Banking crisis fears send shockwaves through markets. There has been a lot of talk lately about the possibility of a global banking crisis, and recent events have only increased those fears. On March 15th, Swiss bank Credit Suisse saw its share price drop a whopping 24% after its largest investor announced that they would not be able to provide any more money to the bank. This news comes on the heels of Credit Suisse's multi-billion-dollar losses associated with the collapse of investment funds Archegos and Greensill Capital. The drop in Credit Suisse's share price had a ripple effect on stock markets around the world, with banking stocks taking the biggest hit. This in turn triggered drops in yields for U.S. Treasuries and Eurozone bonds. Investors seeking safe havens turned to gold, causing gold prices to rally. To shore up liquidity and investor confidence in Credit Suisse, Switzerland's central bank stepped in with a whopping $54 billion. This makes Credit Suisse the first major global bank to receive an emergency lifeline since the 2008 financial crisis. However, the sell-off of Credit Suisse shares has raised concerns about potential problems lurking in the wider banking system. Just 1 day after the wider banking sector share slump, ratings agency Moody's Investor Service cut its outlook for the entire banking system to negative from stable. This was due in large part to the failure of Silicon Valley Bank and fellow U.S. mid-sized lender Signature Bank to rescue First Republic Bank, which saw a 70% drop in its share price last month. Large U.S. banks injected $30 billion in deposits into the lender on March 16th. This move has left many wondering if other banks will need similar rescues in the coming weeks and months. The potential banking crisis has also led Goldman Sachs to lower its forecast for fourth quarter U.S. GDP growth. They cite concerns that smaller banks will pull back on loans in order to preserve liquidity in the face of the crisis. Silicon Valley Bank collapse. What happened and why? On March 10th, Silicon Valley Bank, SVB, a prominent bank in California, was forced to shut down by state banking regulators. This came because of a significant decline in deposits over a short period of time. The bank prided itself on being the go-to institution for the innovation economy and had a substantial client base made up of startups in the technology and healthcare industries, with nearly half of U.S. venture capital-backed businesses having accounts with the bank. The reduction in deposits was caused by many of these clients finding it challenging to raise funds elsewhere. The tech industry has experienced a significant slowdown in startup funding by venture capitalists, which has created a ripple effect throughout the economy. To bolster its balance sheet, SVB launched a $1.75 billion share sale. But this did not alleviate concerns of investors, who were worried about the dwindling fortunes of many of the bank's technology startups. As a result, the bank's stock price plummeted by 60%, causing a loss of over $80 billion in shareholder value. This in turn caused some of the bank's startup clients to withdraw their money as a precautionary measure. Critics have suggested that the collapse of SVB is a signal that the era of easy cash is coming to an end. As interest rates rise, investors are becoming less willing to put their money into early-stage or speculative businesses. Furthermore, corporate defaults are on the rise because of the tightening monetary environment, with S&P Global predicting that Europe had the second highest default count last year since 2009. The same source expects US and European default rates to reach 3.75% and 3.25% respectively in September, which is a significant increase from the previous year's rates of 1.6% and 1.4%. Some experts even believe that pessimistic forecasts of 6% and 5.5% are not out of the question. How the global economy is evolving amidst UK spending power decline, ECB's interest rate hike, and Japan's wage increase. According to the Office for Budget Responsibility, OBR, the UK is currently experiencing its most significant decline in spending power in 70 years. This news follows the government's announcement of a new budget, which stated that the country would avoid a recession this year. However, despite these optimistic predictions, the OBR warns that the UK is facing low growth and high debt. Moreover, the impact of Brexit has caused a downturn in business investment, which will have lasting effects on the UK's economy. The European Central Bank, ECB, has recently raised interest rates by 50 basis points. This decision is part of the bank's continued efforts to combat inflation and maintain stability in the banking sector, despite calls from some investors to hold off on tightening policies until the banking sector stabilizes. The ECB remains steadfast in its approach. The bank's deposit rate is now 3%, its highest level since late 2008. In Japan, top companies have agreed to their largest pay increases in a quarter of a century during annual labor talks. This decision is in response to Prime Minister Fumio Kishida's call for higher wages to offset rising living costs. The decision to increase wages could have a significant impact on consumer demand and how soon the Bank of Japan decides to end its ultra-low interest rates. This is a crucial decision for the country, as the current economic climate demands that the government takes proactive measures to stabilize the economy. How is the World Economic Forum working to make the financial system more efficient, resilient, inclusive, and equitable? In the US, the Consumer Price Index rose by 6% in the year leading up to February, but this was the smallest increase in annual rates since September 2021. The Federal Reserve is divided over whether this will prompt an interest rate hike. In Argentina, inflation has exceeded 100% annually, the first time it hit triple figures since 1991. Turkey's budget deficit has also widened due to earthquake recovery measures, and EU finance ministers are working to reform fiscal rules to better accommodate investment and cut debt for high-debt countries. Lebanon's banks are on an open-ended strike due to legal changes allowing foreign currency loan repayment at old exchange rates. Despite talk of a global recession this year, some economists believe a rolling recession, which affects only certain sectors of the economy at a time, could soften the blow or even prevent a full recession. Let us know your thoughts on these issues in the comment section below. And with that, thanks for watching, and we'll catch you in the next one.